Turning $1,000 into $8,400 sounds like the kind of story you usually hear from lucky investors who happen to buy the right cryptocurrency at the perfect time. But behind most successful investment outcomes, there's often a strategy, a process, and a series of decisions that matter far more than luck alone. The crypto market is known for its extreme volatility, creating opportunities for significant gains, but also exposing investors to substantial risks. That's why understanding how a strategy works is often more valuable than focusing on the final result itself. Today, we will talk about this crypto strategy turned $1,000 into $8,400. Every step explained so. Before we get started, make sure to hit that like button, also subscribe to my channel. 10. It started with education before investment. The first and most important step was not buying a cryptocurrency. It was learning. Many new investors enter the crypto market because they hear stories of people making huge profits. They see a coin rising rapidly and immediately buy it because they are afraid of missing the opportunity. This emotional behavior has caused countless people to buy at high prices and sell after the market falls. The investor behind this $8,400 journey spent time understanding how cryptocurrency works. They studied blockchain technology, market trends, token supply, adoption potential, project teams, competition, and the problems a project was trying to solve. They understood that investing without knowledge is similar to gambling. Education did not guarantee success, but it reduced the chances of making emotional and uninformed decisions. 9. They focused on high-potential opportunities. Not every cryptocurrency has the same potential. Some projects are established and move more slowly, while others are newer and may experience larger gains or larger losses. The strategy focused on identifying projects that had strong growth potential based on research and market conditions. This did not mean blindly buying every new coin promising massive returns. The investor looked for projects with real use cases, growing communities, technological development, and signs of increasing adoption. The goal was not simply to find something cheap, because a low price does not automatically mean a cryptocurrency is undervalued. The goal was to find opportunities where the market may have underestimated future growth. 8. They invested during fear, not during hype. One of the most common patterns in financial markets is that many people become interested only after prices have already increased significantly. When everyone is talking about a certain investment and social media is filled with stories of easy money, the biggest opportunities may already be gone. The investor, who turned $1,000 into $8,400, understood that markets move in cycles. Instead of buying during extreme excitement, they looked for opportunities during periods of fear and uncertainty, when many investors were selling and prices had dropped. This approach required patience and courage, because buying when others are afraid is emotionally difficult. However, periods of fear have historically created some of the biggest opportunities for investors who correctly evaluate the risks. 7. They manage risk instead of going all in. A common mistake among inexperienced crypto investors is placing all of their money into one asset because they believe it will make them rich quickly. While concentrated investments can create large profits, they can also create devastating losses. The investor treated risk management as a priority. They only invested money they could afford to lose and understood that cryptocurrency can experience major price drops. Protecting financial stability was more important than chasing a dream of overnight wealth. Successful investors understand that staying in the game for years is more valuable than taking one reckless gamble that could destroy their entire portfolio. 6. They ignored daily market noise. Crypto markets never sleep. Prices move 24 hours a day, and news, social media posts, and opinions appear constantly. Watching every small movement can create emotional decisions. A small drop can create panic, while a sudden rise can create greed. The investor focused on the bigger picture. They understood that short-term price movements do not always represent the long-term potential of an investment. Instead of constantly buying and selling based on emotions, they followed their original strategy and gave the investment time to develop. 5. They understood market cycles. One of the biggest lessons in cryptocurrency is that markets move through periods of optimism and pessimism. There are times when prices rise rapidly and times when the market experiences painful corrections. Many inexperienced investors believe that prices will continue moving in one direction forever. The investor studied previous market cycles and understood that emotions often drive extreme movements. During a strong upward trend, they remained careful and did not assume that prices would increase forever. Understanding cycles helped them make more rational decisions instead of being controlled by excitement or fear. 4. They had patience when others gave up. The journey from $1,000 to $8,400 did not happen overnight. There were periods where the investment moved slowly or even lost value. This is where many investors fail. They expect immediate results, and when their investment does not quickly make them rich, they sell and move on to something else. Patience became one of the most valuable parts of the strategy. The investor understood that big returns often require time. They were willing to tolerate uncertainty while allowing their investment thesis to play out. This patience made the difference between capturing a large move and leaving too early. 3. They had a plan for taking profits. One mistake many investors make is focusing only on buying but never thinking about selling. When prices rise, greed can make people believe that gains will continue forever. Many investors have watched huge profits disappear because they refused to take any money off the table. The strategy included a profit-taking plan. As the investment increased in value, decisions were made about when to secure some gains rather than relying completely on the market continuing upward. Having a strategy before emotions became overwhelming helped protect the profits that had been earned. 2. The biggest return was the knowledge gained, although turning $1,000 into $8,400 was an impressive financial result. The most valuable return was the experience gained along the way. The investor learned how markets behave, how emotions influence decisions, how important patience can be, and why research matters. Money can be lost and earned again, but the skills developed through studying investments and understanding risk can continue creating value for years. The journey created a stronger investor who could approach future opportunities with more discipline and knowledge. 1. The real secret was following a strategy, not chasing luck. The number one lesson behind turning $1,000 into $8,400 is that successful investing is usually built on a repeatable process rather than random luck.
Many people enter the crypto market hoping to find a coin that will increase hundreds of times in value. They chase social media trends, buy because others are buying, and sell because others are afraid. The investor in this journey approached the market differently. They researched before investing, accepted the risks, stayed patient during uncertainty, ignored short-term noise,
understood market psychology, and followed a plan for both entering and exiting positions. While no strategy can guarantee another 8x return, the discipline behind the strategy is what gave the investment the opportunity to succeed. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.